Welcome to the webinar. We are so excited to be here today. Hi, Camilla.
Hello.
So good to have you. I've been looking forward to doing this with you. We're going to give it a minute or two to see people joining. I hope people have the link and are coming in. I can't see the folk joining. Can you, Rodney? Okay. Let's see. Yeah, people are joining. Thank you for joining us, everyone. I can't see names to say hi, give a few shout outs. Yes, well, there's all of us here. Emma, thank you for joining us. I can see Emma is on. Tebi, thanks for joining. Thank you, Joseph, for joining. Chantel, Mukami, hi Mukami, thank you for joining us. Hi Emily, Linda, thank you guys for coming on. We are giving it a minute or two to let people join us, and we're going to go live. Really excited about this. The second in our Girl Money Geeks Masterclass series, Investing 101 for Women. I think this is such a big topic. It's definitely one that's close to my heart because of everything that I've been through with time, and how important I think investing is as a backbone for society. Ruth, I see you. Thank you for joining. Savannah, Fiona, good to see you. Kachi, Martha, thank you, everyone. I think we have a quorum. We have a lot of people signed up for this webinar. So thank you, everyone, for the support. And, it just validates the fact that as girls, we are looking to do more with our money, and we are ready to take the bull by its horns. So welcome, everyone, to the webinar. Thanks for joining. We want this to be very interactive. So let's start by testing the interactivity. We'll kick off with a poll, which you should see on your screens now. If you could please let us know how confident you feel about starting your investing journey. And we'll do the same question at the end of this to see, how well the knowledge has sat in. If you have any questions in the meantime, you should hopefully be seeing a Q&A section. Test it out. The team will pick up as many questions as possible. I have an expert with me, Camilla Esmond, so we're going to be going through as much as possible. We'll pick up as many of them at the end of the session. And if we've not answered any of your questions, don't worry. We have a forum that you can join, and we'll respond to them with time. So thank you so much for joining us today. I will go on to some housekeeping before we begin. This session is being recorded for a podcast, which will be available across the main social platforms. So if you've opted into our mailing list or joined the Mathematics community, you'll receive an update when this goes live. And now on to the heavy stuff. Welcome again, as I said, to this Investing 101 Masterclass. Before we begin, please note that this session is for informational and educational purposes only. We're not providing financial advice, and nothing discussed here should be taken as such, because everyone's financial situation is unique. So we strongly encourage you to seek independent financial advice from a qualified professional. This is essential to ensure compliance with relevant financial regulations, including FICA requirements. And as I said, want this to be interactive. I hope you've been able to use the poll that we've started out, and the Q&A will be open. Put in your questions at any point at all. My team will cue us when it's time to answer these. The next thing we're going to chat about is my investing journey, because, why am I here? Why am I even running this? Why am I doing this? I am Tina Matembe. I'm the founder of Mathematics, which I set up just over 6 years ago. I feel really old. But maybe just to give you a bit of background, I moved to the UK 16 years ago. And when I moved here, I had never known luck, never. And then suddenly I came to the UK and became financially vulnerable. And life shifted so fast. I just found myself vulnerable because I didn't have a credit history. Nobody knew me. I couldn't rely on my networks from before. And I had just never known poverty or not being able to achieve anything I wanted to. It was the scariest time of my life. I just felt so helpless. And I was so angry because I felt like this was not anything I had done wrong. So that experience made me rethink what financial well-being really means. especially as a mother. I fell pregnant about literally 3 months after coming to the UK. And so now I was a mother contending with financial vulnerability, almost bringing a child into this world and just having no clue how to make life work in the UK. And I had lived a very flamboyant lifestyle. I love the finer things in life. I've just been a lifeist, so to say. So suddenly taking all this from myself felt really, really scary. And it was not because I'd made any bad choices. It was because I didn't know how the UK system worked. And there was no information available to help me. And that's the thing about it. Sometimes it's not anything you've done wrong. Sometimes it's about accessing the right information. So that experience just scared the heck out of me. I wasn't going to let lack of knowledge put my future or my children's future at risk. I became obsessed with acquiring and applying wealth building knowledge. I wanted to live in the same type of house I had lived in growing up, which was a big, flamboyant place. I wanted to be able to go on holidays often. I just wanted to have a good life. And the society here seemed to frown upon someone that wants to live a good life. And, I just thought, no, I need to make myself knowledgeable. I need to do things to safeguard myself. So I opened my first investment account about 2 years after we came, and I was so scared, so scared. All the jargon, the language. Mind you, I was coming from Uganda, where I had my interaction with the bank was working for one. I had never had an investment account before. So when I opened my first investment account, I actually didn't touch it for a year. I opened it and I would go and look at it, and I wouldn't do anything. And eventually, having a conversation with another couple of friends, myself and my husband, we decided to do a joint investment account with them. And so we went away and studied together. I hope actually one of them is on the call today. I saw she had signed up earlier in the week. But we just sat down and said, listen, we don't know what we're doing here. Poverty is not an option. Let's educate ourselves. And we started investing together. So one thing I say is I'm unapologetically an unapologetic wealth builder, not because money is everything, but because life is so much easier to navigate when you're not worrying about money. So in my case, I'm like, well, I'm choosing my hard, and my hard is not the one of financial struggle. I want to choose one of hard work, building stability, and so I choose wealth. So eventually, after doing the investing with a couple, we did that. We still do actually invest together. We have quite a few investments together. But after about a year of testing the waters, I felt ready to start doing my own investment journey. So I've gone ahead to invest in so many different things, and set up Moneymatic and just be on this quest to make financial education practical, honest, and culturally relevant. Because in my case, I was coming from a different place. My work has led me to do a few things. I wrote a piece for the Scotsman where I was talking about my investing journey that I've just shared. And also, again, as I was doing all the research, I never ever found resources that looked like me or the journey that I had walked. And I was really, really keen for stories to be shared. So I wrote a book called Thriving Beyond Borders. It's on Amazon, and it just shares the journey of 10 people who have moved to the UK. I shouted out one of them who's already on this call. Mokami's on the call as well, I noticed. And it's just showcasing different people's journeys with money because it's not talked about enough. And I'm just all about educating and showcasing different things. Most people I coach start cautiously, like I've mentioned, but the key thing is getting started, get your foot in there, sign up for an account. And so I'm here because I want you to feel confident enough to take that first step, no matter how small. So this webinar hopefully gives you clarity, action, and choosing to build better. I'm so excited to be joined by the amazing Camilla Esmond, who's the retail investment expert and senior manager at Interactive Investor. Thank you so much for being so generous with your time, Camilla. It's been awesome working with you towards this. And you are at Interactive Investor, which is one of the UK's largest investment platforms. Camilla has worked with teams of experts across personal finance, pensions, and investment at this leading flat fee investment platform, Interactive Investor. She has a personal and professional passion for financial education and creating practical solutions to addressing gender investment gap. Camilla joined Interactive Investor from Investment Association, where she worked with the corporate affairs function at the Investment Association. She's worked Her work has ranged from consumer investment trend analysis to content creation across various policy areas, including capital markets, sustainable investment, and corporate governance. Camila also writes and comments on various investment topics for media and has a regular column in City AM, breaking down complex financial topics and helping consumers understand what it means for their money. Camila, thank you so much for joining us. I can't wait to hear your story on how you got into investing yourself. Please do share with us because this is important. Over to you, Camila.
Thank you. Thanks, Tina. And I loved hearing about your journey. It's so amazing. I love what you said about being unapologetically a wealth builder. I think we need a lot more of that rhetoric when we talk about these topics and we have these conversations. Because you're right, everyone is entitled to, fulfilling their goals, whatever those goals are, big or small. And this is why I'm so passionate about what we do at II and what our industry can do for people generally. I really believe that, as you say, with more conversations, with better and more accessible education on finance and breaking things down, we can encourage people and show people that they could build the financial resilience and reach the goals that they probably never imagined they could. And that's incredibly powerful. So thank you so much again for having me. I'm honored to be here and I love what you're doing. And I think thank you for sharing your journey as well, because it's going to inspire so many people. But as you said, so I've worked in the investment industry for quite a long time now, around 8 years. And my investment journey has kind of evolved in tandem with that, with working in the industry. As you said, so I used to work at the Investment Association, which is basically the trade body for investment in the UK, which was amazing. So, all of the things policy-wise that the industry does to try and make the industry accessible to everyday investors, ISA holders, pension holders, and institutional companies as well. That's what they look after. So I was kind of in the midst of, as you say, so many different areas, whether it was, ethical investing, which has been a huge topic over the last few years, whether it was making sure that products and services in investment are labeled and, explained in a way that is accessible to retail. That was a huge thing. And that's obviously been really helpful in my job now. And I loved it. And I, by being in so many different areas, working with experts across the industry at that place, I was learning a lot myself that I was able to take on my own investment journey. Because, even though I've worked in the industry for however long, I'll be honest, I think I was quite intimidated by money prior to working in it. So I'm very lucky I've been able to work with some amazing market leading experts, and I do still at Interactive Investor, who I've had, discussions with and learned from. And obviously, as I've been writing more and thrown into the mix a lot more on loads of different topics for end investors, for everyday consumers, I've really developed, my own journey alongside it. And it's been a kind of hand in hand reward for me, I suppose, in my journey. But yeah, and I found a real passion for the education side. I joined II around 3 years ago now, and write a lot for press and work with the media to try and break down these complex topics and make them accessible. And in doing so, I think it's actually helped build my confidence as well. And it's funny how sometimes you can work in something, but your own personal journey doesn't always reflect that. And more as I've worked in this industry, it definitely has. So I just want to share that, really.
That's so true. And also you evolve, as you're going on your investment journey, or you're even just your money, your budgeting, getting of things. I just remember feeling so ashamed for not having a credit score, but it was no fault of mine. But you just there's a guilt that comes with it that's unwarranted.
Yeah.
So much for sharing that. I think we should dive briefly into this slide around the gender investment gap and why it matters. Do you want to cue us into
so something I'm really passionate about, and Tina, I know you are as well. So this is a huge topic. There is essentially, in short, there's a huge gender investment gap in the UK. Interestingly, we're seeing more and more women are saving, and we'll come on to this, but still, not enough are investing, and we'll come on to the differences there. But obviously, it's great that women are able to set some money aside to have that safe tucked away, but really they're not growing their money in the same way that men are in the UK. And the reason this matters, in short, is because if fewer women are investing, fewer women are able to reach their financial goals. So all of those goals that you set out for yourself personally, even if it's tiny goals, it's the less women that are investing, the less chance that they're actually able to reach these. So it does matter, and it comes down to so many different factors. There's a lot of systemic challenges that women face when it comes to building wealth. Luckily, they're more and more talked about now, which is fantastic, and it's very much more researched now. But essentially, things like the pay gap obviously has a natural relationship to this. If you're being paid less, you're probably having less to set aside for investing. Things like the so-called motherhood penalty, which essentially means if women are taking time out for to look after kids, they're taking time out of the workforce. They are usually you'll have slightly reduced pay. We actually did something recently on maternity pay and pensions, which I can share afterwards because that's quite interesting as well. And also, obviously, childcare is really expensive in the UK. I think it's one of the highest in Europe. So you've kind of got a perfect storm of challenges there that women are facing when it impacts their ability to build wealth. So that's something that we need to keep talking about. But it is changing, although we know that the gap is still a staggering 567 billion, which I know you were quite taken aback by. When you put it like that, it really does hit home, doesn't it?
It does. It's crazy. And I think one thing that I was reflecting on about this is that our beliefs about ourselves profoundly shape our financial interactions. So as a woman of color, for example, I'm always keen to point out that women of color are probably the most underreported investors, because research into informal economies and community finance consistently demonstrates that we significantly contribute to our communities. We support family businesses. We participate in informal lending circles. So while traditional financial data often overlooks this investment activity, the reality is that most of you on this call have invested. You've crowdfunded for a family member before. You've lent someone money to start a business. So you're already an investor. You just don't see yourself as one because society is telling you maybe you shouldn't be doing this or you don't know how to do it. So that should hopefully help your mindset today in terms of you're already an investor. If you've given to a good cause, if you've invested in someone's business, you just need to be more intentional with your own strategy and building upon your financial acumen, and you can do it. We are in charge of this 567 billion gap ourselves. Men or anyone else are not going to come and help us to achieve this. So we just need to take the bull by the horns, as I say, and you're already probably investing. You've got it inside you. You just need to, do that. Camilla, I wanted us to touch a bit on the data around, this, because the data definitely shows a different picture, which hopefully will lend the people viewing this into understanding that any one of us can and should be investing.
Yeah, so we've done a lot of research on this ourselves, and I'm always quite frustrated, really, that the narrative around, as you say, how we label women in terms of their money and their behavior around money is not the most productive. In fact, it's counterproductive, and I don't think it's very inspiring for a lot of women. So we wanted to dive into this and see if some of these stereotypes and generalizations that we hear so much about women being, less interested in investing, even less capable and need more hand-holding. That's something that was kind of a wide stereotype. It's just not true. The data doesn't reflect that at all. And as you said, we are the second largest investment platform in the UK. So we have quite a large data set to use, which is brilliant. And as you can see, the charts aren't always super easy to read. So if anyone has questions, obviously do ask later on. But the pie charts there between men and women, that shows the asset allocation. So how women and men on II are splitting their portfolios in terms of different asset classes. And the performance and the actual holdings themselves are really, really similar. So we never find any data points that point to a really different strategy between men and women. And women on Interactive Investor do generally perform really well. And they've actually outperformed slightly over the last kind of 5 years that we've looked at this data. And bear in mind as well, over those 5 years, the markets have, peaked and troughed, as they often do. So they're really taking long-term, well-balanced strategies and diverse portfolios. And I think this is something that we need to recognize and celebrate, because even though we still have that gap in terms of women, as you say, feeling like they are investors and feeling empowered and investing in, say, ISAs as opposed to just in cash. when they are investing, they're doing really well. And so I think the more we reflect that and we talk about that, the more we can hopefully inspire, as you say, more women to think, oh, actually, I can do that too. You know, I can do that just like someone else can. And this is how people learn. This is how people, you know, are inspired. So I would like us, you know, to move away from these generalizations. They're just not serving women at all when it comes to money and building wealth. So yeah, the data is powerful.
Yes, I think it really is powerful. And back to that thing around mindset, like if you feel like, you know, I shared about my journey coming here, and I had just grown up with my parents saying to me, whatever you put your mind to, you can achieve. And so when I hit these barriers that I'm telling you, my mindset was already that, listen, this is a barrier that's got nothing to do with me. I need to get out of it, just get myself up there. So please, everyone on the call, if you've been concerned about your own journey, your credit score is not great, you've had so many troughs, you know, you've gone through so much, you can get out of it and start at any point. I started when I got here, I was about 26, and I from scratch, and I've managed to do it. You can as well. So I'm always really keen to give people value. Camilla, let's just go right into like education now, education mode. One of the first I was like, is what even is an investment platform, right? Let's go into that now.
Yeah, so this is still quite an understood area of the market, but you've probably heard of them. Hopefully most people on this call have heard of them or seen them. There are so many different ones out there. Obviously I work for Interactive Investors, so bear in mind that I'm really speaking from our perspective. But when you are looking at platforms, and I know Tina will come onto this, really take the time to assess which one is best suited for you. There's so many different considerations to look at, which we'll come on to. But really simply, an investment platform is just an online hub where you are buying, selling, and holding your investments. So we obviously work for Interactive Investor. There's another, we're the second largest. There's also AJ Bell, which is quite large, you may have heard of, Hargreaves Lansdown. There are some they're so-called neo brokers called Trading 212 and other ones like that you may have seen, and do quite a lot of marketing. And they are all the kind of same premise. Each of them will have different resources. So on II, for example, we have loads of educational content. We have tools that I'll come on to help people navigate their investments and make informed and confident decisions. Every platform is different, but they are basically where you kind of house your investments. And on those platforms, you have different products. The most common ones there that you can see are individual saving accounts, so ISAs, which hopefully most people have heard of, but it's still a really misunderstood area of the market, really. Self-invested personal pensions, or SIPs, which again are really not very well understood either, but can be brilliant tools for building wealth, and general investment accounts, or GIAs. Some platforms will offer junior ISAs as well, or JISAs, which we do at II, and I think most of the main ones do. And that's a great tool for building a nest egg for kids. So within these wrappers, that's where you choose what to invest in. And this is where there's a bit of confusion sometimes, where people, and it's completely understandable because these things aren't taught a lot, growing up, and it can be really confusing. But essentially, people sometimes get confused between the platform and the wrappers. But the platform is where you're holding your investments, and you choose the best one for you and what you need from your platform, and costs, which we'll come on to. And then within that, on that platform, you can have all of your products, your ISA, your GIA, your SIP, whatever you choose to hold. So that's how they relate to each other, but it can get quite confusing.
Thank you, Camilla. And I'm so grateful that you have, because again, you're from Interactive Investor, but I think just to let everyone know, we are trying to make this as transparent and educational as possible. So yeah, for Camilla to mention even the other platforms, it's just for us to try and give you that information that's out there. Go and do your research and find, what works best. I remember hearing so much noise when I was trying to choose a platform. There were all these sorts of platforms. Then there was the junior ISA. I toyed with that for a long while, but when I started investing, actually the junior ISA wasn't as it is now. It was a different makeup, but there was just so much noise. And so for the people that I coach, I use this method. I tell you to use the safe method when you're choosing an investment platform. And that's what I did. I wanted a platform that was simple. So because it was a minefield, all the jargon and that. So if you just shut yourself to the noise and use this safe method, look for something that is simple, easy to navigate, with clear instructions, no intimidating dashboards, If I couldn't understand it within 10 minutes of signing up to the account, because signing up is free. So sign up for as many of them as possible. Go to Interactive Investor, go to all of them and sign up, and, choose the one that you feel like, this is an interface that I can, get on board with. I understand what they're saying. I understand their education, because they all try and educate you as well. Simplicity is really important, because if you feel intimidated with that, you're not going to want to use it. Affordability is really important, and Camilla will chat about this later in the webinar. But compare the fees, and there is nothing like no fee. Just compare. Make sure you understand the platform charges. Do they charge you when you're funding? Do they charge you for every transaction? What are those costs? And don't think of them as trivial. Even a small difference adds up over time, because remember, you're hoping to invest over your lifetime. So it's really, really important that you understand what the costs are. Go on there. If you don't understand the costs from reading about them, click on the chat function of the platform. Tell them, I want you to give me a plain breakdown of what the costs are. For me personally, flexibility was really important, because I wanted to start, I was just dipping my toe in when I started. So I wanted to be able to invest. I remember at the start, I was investing around 25 to 50 pounds, right? I needed a platform that could let me do that and change it up. You may have different needs, or you may be a different type of investor. Some people want to just have a chunk of money that they put in at a time. But for me, flexibility is really important. I want to be able to change my strategy. I want to be able to put in a monthly contribution, or change it if I want to, with no penalties, because back to the fees, some of them penalize you to change your strategy. So look for flexibility. And then make sure, this is a must, make sure that it's regulated. It has to be compliant with the laws. That's very important. Is it established? Is it FCA regulated? But as I say, open accounts, browse the different types of things, and look at how you can get yourself on the ladder, get familiar with it. So regulation is important, though. Don't go on anything that's not regulated. Make sure it protects you. Right now, the FCA is covered by FSCS, which protects you with up to £85,000 of your money. Should a platform go bust, should the economy change, £85,000 is protected. Make sure it has that. I hope that helps, because it's a minefield just even choosing platform. So this is going to be an interesting slide, because Camilla is now going to dive into what Interactive Investor do.
Yeah, so that was a great, really good method there, because it is really, really overwhelming. And I think, if I didn't work for a platform, I would find it really difficult. There are so many different comparison sites as well out there. You might want to look at Money Saving Expert, for example, or Which. They both do really good, non-biased breakdowns. They even have recommended platforms and things, so it's worth looking at those. Yeah, so II, we are the second largest platform in the UK, trusted by over 400,000 investors. And most of our investors have been with us for more than 10 years. So people that invest with us invest for the long term, which is obviously brilliant for us, because investing is a long-term game, which we'll talk about. But that's very encouraging. And it also means we've got brilliant data insights that we always use for educational purposes, to showcase how our investors who are doing really, really well are doing it over the long term, and how it's paying off. And yeah, brilliant, reviews on Trustpilot and everything else. And we're really proud of what we offer investors. And we're basically all about transparency and education, which is why I think, there's a natural synergy with what we're talking about today. But we're a flat fee platform. So when it comes to charges, as Tina says, there's different charging structures. And yeah, if you are unsure, and it can be confusing, it really can be, do ask the questions. Don't be afraid to ask. You need to be able to understand these costs, because as Tina says, they can add up. And a lot of platform fees are percentage based, whereas we are flat fee. So speaking frankly, if you have a smaller pot that you're investing, a percentage fee charging structure may make more sense for you, because you're being charged a percentage. So it's a small percentage, and that might be more competitive for where you are. However, as your wealth grows, as your pot grows, you might find that a percentage fee structure doesn't work for you anymore, because the percentage that you're being charged will be higher. So it will gradually eat into your returns over time. So that's where it's good to evaluate when you're starting out, but also keep evaluating as your pot changes and hopefully grows, which it should over the long term, because you might find that a different platform works for you at a different time as well, and that's completely fine. So it's really, really good to get savvy around fees and charges. And it really, it's a long way to go before it's really clear for consumers, to be honest. We do a lot of research and campaigning on this. But if you are unsure, definitely ask the question. You deserve to know, and it should be transparent. So yeah, that's II. But we've got it's just ii.co.uk if you want to have a look at our website and have a look at our educational content, and our podcast as well.
Great.
Yeah.
So I think this is the next important one. Why is it important to start investing? According to Barclays Equity Guild study 2024, UK stocks have on average returned a higher investment, as you'll see from what Camilla is going to share. And there's lots of gaps. So maybe Camilla, you can touch on this one.
Yeah, so this is a really big topic at the moment, especially, if you're keeping up with this in the news cycle at the moment. There's a lot of talk around cash ISAs versus other types of ISAs and the allowances on those. And obviously, there are so many reasons why some people might hold cash, especially in the short term. It's considered quite safe, and for those kind of short-term goals, you are just setting aside money that you might need, and that is no bad thing. However, if you are looking to grow your money over time, the data doesn't lie. Over time, investing, especially in the stock market, gives you a greater chance to grow your money considerably more over time. And you have to bear in mind that investing is never without risk. There are ways that you can reduce risk significantly, and we'll talk about diversification and some of those strategies that you always have to bear in mind with investing. But definitely make sure that you are comfortable with the fact that there will be risk involved with investing, but there are areas where you can mitigate that and spread your risk. This is particularly interesting now with what's happening in the markets. There's obviously a lot of market turbulence at the moment, especially with what's going on in the US, and it can be scary. So it's probably, for some people, the last thing they want to start thinking about is investing in the stock market right now, which would, be understandable. But it doesn't have to be scary. And these market peaks and troughs happen all the time over the course of investing. But you want to look at the long-term trend and always think long-term if you are in it to invest. So yeah, if you're staying invested and you're staying diversified, you will also benefit from something called compounding or compound interest. And without getting into the jargon of it, because again, we don't want any jargon here, but it's essentially quite encouraging, because it means even if you're just putting away, as Tina was saying, like regular amounts of money, and you're drip feeding it into the market, something called regular investing, over a long period of time, you will have those growth benefits from compound interest, because you're essentially getting the interest on the accrued sum and then more interest. So you're reinvesting any interest on that accrued sum and then earning any interest on that too, which sounds very complicated, but it basically just means it snowballs. So if you just imagine literally the snowball effect. And the reason why you should get to grips with something called compounding is because with saving and investing, it works in your favor, because it's snowballing your gains over time. And the longer you can leave it, the longer it's going to benefit you. But obviously, if you're in debt, it can work against you. So it's a really core concept, which when broken down is actually quite simple, but it often sounds more complex than it is. But it's important because it kind of works for or against you, depending where you are on your journey. And we'll come on to this. The pensions landscape is very complicated. A lot of people don't consider their pension or pensions an investment, but they are. We were talking about this before, Tina, but I know we were talking about how a lot of people who probably have a pension don't consider themselves investors. But if you have a pension, then you are an investor. And that's a great thing, because that's basically your future you fund. But because the landscape has changed for pensions over the last, particularly in the last few years, and even at the moment, there's a lot of news on this, the onus has shifted more and more on individuals. So the state pension has recently actually increased, but it's just not enough given the cost of living and everything else most of the time for people to just have that and rely on that for a comfortable retirement. And that's without looking at, everyone's got a different idea of what their dream retirement looks like, right? You might have holidays planned or things or big goals that you want to achieve in retirement, and you need to be able to fund those. and relying on the state pension is not going to be enough for most people. So there's a real onus to get to grips with that earlier. And the pensions world is not very engaged on in the UK as well. That's something we've done a lot of research on, but it is important to think about early if you can.
Absolutely. And I think, back to the point about you're always learning and you're always looking to improve.
Yeah.
I've looked at investments until January when we had an event. We had a Grow Your Money event. And in that session, we talked about pension and pension gaps. I had never thought of pension as an investment. I always thought about my funds, my, EFTs and that. I had never seen pension as that. But if you're, for example, someone like me who worked in other countries, or you've had a gap in your career, you've taken time off to have children or that, it's very likely that your UK pension contributions are lower than they could be, meaning that when your time to retire comes, you may receive less unless you take steps to catch up. So think of your pension as also an investment, because I definitely didn't do that before. And they're filling in those gaps by making something called voluntary national insurance contributions, or you increase your workplace or private pension contributions if you can. It can be a great investment as well. So just, look at your pension as well as an investment, and it's worth checking your state pension forecast. You can check your state pension forecast on gov.uk to see where you stand, and then you'll see the gaps and you'll be able to see what you can do to fill in those gaps. I guess we should also dive into this as in terms of why investing in the first place. But on this as well, what I'm going to do is I'm going to have a quiz question put up, just for the interactivity and to get you guys thinking. If you delayed investing £50 a month for the next 5 years, how much less do you think you'll have in the next 30 years? If you can respond to that quiz, and you'll be just flabbergasted by how much it actually is. But Camilla, do you want to go ahead with this one?
Yeah, so this builds on nicely from what we were just talking about. So fundamentally, if you are investing, you're giving yourself a greater chance over the long term to build wealth and achieve your financial goals. You're going to get a lot more, hopefully, growth on your funds than just having money in cash. Cash can offer that short-term security, but investing over the long term is giving you more growth on your funds. So if you've got big goals, then that's a really key way to think about why you should be investing if you can, and if it's the right time for you to do so. To stop inflation eroding the value of your money, this is a really big one. So again, going back to the kind of cash savings and investing topic, inflation will erode the value of cash over time. So if you are investing and you're investing in a tax efficient wrapper like an ISA or a SIP, you are shielding your gains from tax. So your money is growing and it's also being shielded from tax. So it's not being eroded. So that's another way that, again, you're more likely to grow your money if you're investing for the long term in an ISA or say a SIP, and hopefully to achieve those financial goals, whether that's a dream retirement or some sort of life goal. And then again, I've just touched on this, but tax benefits, it can be really tax efficient. Again, if you're using those wrappers to your advantage. This has perhaps never been so important because the individual tax burden has increased a lot for various reasons over the last few years, especially recently. And there's a horrible piece of financial jargon called fiscal drag, which essentially means more and more of us are literally being dragged into paying more tax because of changes to frozen thresholds and changes to personal allowance. So that's something to consider as well. But if you can make your investing tax efficient, it's only going to be beneficial because you are literally protecting your money. Benefits of compounding, I talked about this before. Again, it does always sound more complicated than it is, but it just means, if you're being regular with your investing and you are putting away even small or modest contributions to an ISA or to a SIP over time, it will compound and you'll get that snowball effect over time. And that's quite nice because you almost don't have to really think about it. Again, if you give yourself a really long-term horizon and you stay disciplined. And this is the last kind of benefit, really, is we don't really talk about this, but it's a really rewarding exercise as well for a lot of people, hopefully. And this is what I hope people do find as they begin their journeys and they start to see the fruits of their diligence with their regular investing over time, 5-10 years, and you look at how much you've you've grown your money. It's about financial discipline. It's about habit formation as well, and that can be a really empowering feeling. I hope, and hopefully you'll find as well if you explore this.
Very good shout. I think one thing I wanted to add on this is that please do not confuse investing with saving,
Mm,
because it's very easy to confuse it. But the way to think of it is savings will protect your money, but they don't grow.
yeah.
So if you have money in a savings account, you have a chunk, you've put it away, it's not going to grow. If you're only saving, you're standing still, and inflation is quietly eroding the value of your money every year. Whereas investing is a necessity if you want your money to grow faster than the cost of living. So playing it safe is not going to help at all. You need to make your money do a bit more risky stuff. Maybe not all of it, but please don't confuse investing with saving. They're two different things. One of them is compounding and growing. And maybe just to share a funny story here at this point, when my very first investment was a share that I didn't know paid dividends.
Mm,
So I was just so shocked. I got this email saying, we got an email saying, oh, the stock has performed really well and now you're going to get a dividend. It was such an exhilarating feeling,
yeah.
and very timely as well. But when we were investing, it's not something we even knew. We were just investing blind, we're just going blind. But you're right, it can be such a good feeling just to know that, there's money somewhere that's working for me. And hey, sometimes you could get a dividend on it, even sooner than you hoped, because you need to think about your time scales. Are you investing for 5 years, 10 years, 2 years, whatever?
Mm,
And for us, it was just this lovely surprise to have a
yeah.
dividend at the end of the first year. So please, investing is different from saving.
Yeah, it's
I
a good
think
point.
maybe it's time to now dive into, Camilla, the whole thing of when do I even know when to start investing? What's the
Mm,
test before I
yeah.
should say I'm ready to invest?
Yeah, this is a really, really key area. And this is the thing that you need to be very honest with yourself before you start thinking about investing. As I said, some of you who have pensions but don't necessarily have ISAs and things, you're already an investor in that sense. So that's something to bear in mind. And that's definitely something you could really nurture and pay attention to, really engage with your pension savings, even if you're not, opening an ISA. But yeah, there are several things that, generally speaking, it's wise to think about before investing. We talked about savings. If you do have savings already, that's a massive benefit. So again, this isn't financial advice, but a lot of advisors usually say, if you have rainy day funds just in case, because life is, as we all know, unpredictable. And as I said, investing is not without its risks. And that investing that you're doing is for a longer term horizon. So if you do have those savings for that short term kind of safety net, that is a really, really good starting point. They usually advise around kind of 3 to 6 months salary, which depending on your circumstances will be more or less realistic. So always do what's right for you. But it's a good idea to have that kind of short term cushion. And again, clearing debts. So it's not really wise to think about investing before clearing debt, because you want to be building from the best position that you can possibly be in. First of all, you won't feel as empowered. It's just going to add more stress probably. And the last thing that we want for anyone's investing journey is to be stressful. That's exactly the opposite of what we want to do. So it's good to really get to grips with trying to clear debt first. And this is, and kudos to people that do it. It can be, there's so many things that come into this, and it's emotional and very stressful for a lot of people. And there are services out there that are able to help with that if you are struggling. But that is definitely something to think about before you think about investing. Because again, this is a long-term strategy. Short-term, you need to put yourself in the best position possible before building. Think about why you're investing. As Tina said, had all of those amazing goals. What are your goals? And I agree. What anyone can achieve anything, and it sounds cheesy, but it's true. And don't limit yourself. There are ways that if you are again thinking and planning ahead, and you're starting as early as you can, then there's no reason why you can look towards those goals. And investing can definitely help turbocharge that to reaching those. I think about your risk appetite. This is huge, really, really huge. If you're not sure, there are so many different services out there that can help. There are guides on our website, for example. Obviously, financial advisors do a lot to help people as well on this. It's not always easy, but think about your age, your stage of life, and be realistic and be honest with yourself. This is kind of key to everything, really, is being as honest with yourself as you can, because again, you need to be comfortable that if markets do dip, and that can be really disheartening. Obviously, hopefully, if you're investing long enough, it'll recover, and they do recover over time. But be comfortable with the risk that you're taking with your investments, and generally speaking, and just really, really get to grips with that. And if you're not sure, look out for some services that can help, and there are quite a few. And then, yeah, we talked about this. Time horizons are key. 5 years is usually viewed as the minimum period, and that is the minimum if you're looking at kind of an ISA, for example. So it'll depend on what goals you have, short term, long term, but generally speaking, think about your investments as your long term goals.
That's a very good shout. Thank you, everyone, for the questions you're asking. Maybe let's just dip into the Q&A slightly. Lara has asked a very good question on this slide around, would you suggest investing without a rainy day fund saved? Are there any other financial choices that should be made before investing? Maybe you want to touch on the rainy day.
Yeah, I mean, honestly, there's no rule for one person. It's just so usually, my personal opinion on this would be it's wise to try and build that rainy day fund first, because you just don't know what is around the corner. Unfortunately, life is wonderful but unpredictable a lot of the time. And again, if you can put yourself in the best position possible, that your investments are additional to your wealth building, they are for your long-term goals, but you are still comfortable in the short term. Hypothetically, if something went wrong, if your employment status changed or a life circumstance happens, you're still comfortable. But do what's right for you. And I'm not, again, I can't give the financial advice, but that would be how I would play it personally. And if you're not sure, there's actually a really good website called Money Helper, and that's got some great resources as well, and some guides there in terms of how you can navigate that. But it's a really good question. It does sound like quite a lot to have 6 months salary in cash. I don't think that many people do, and I'm not necessarily I don't think that's the most realistic for a lot of people. But if you can have enough of a rainy day fund that you are, should something happen in the short term that knocks you, and you're not putting yourself in a financially vulnerable position. That is just rule 101. Is before anything, do not make yourself more financially vulnerable than you need to be. But as I said, if you're not sure, ask. Yeah,
I agree. And I think it's also trying to get the balance, because in my case, for example, one of the always encounter when I'm coaching people is fear of missing out on investing, because you have a lot of debt and you're telling me, I'm saying to you, clear up your debt, but then I feel like I'm passing up on investing. And we had a big conversation around this, and how actually clearing up your debt, for example, is also investing, because now you don't have this huge burden on your mental health, on your pocket, that's going to affect you. So it's thinking about things like that. Let's take another question and then we'll continue. Emily has an interesting question. Emily asks, I invest with my bank. It feels like the safest and easiest option with the lack of knowledge I have at the moment. Is that right? What do you think? Plus, in what ways can investing work against you if you find yourself in debt? A very good question, Emma.
Interesting. Investing with your bank, it really depends what it's actually invested in. So a lot of retail banks offer ISAs now, and it's hard to say in too much depth without knowing what it's invested in. I think you just need to work out, get to grips with what it's invested in. If you're not sure, ask, and ask yourself whether that makes sense for your stage of life. A lot of younger people can probably afford to, it's always about diversifying, which we'll come on to, but can take on a bit more risk because they've got longer for that money to grow. But there's no kind of, this sounds corny, but there's no kind of right thing. It's more what's right for you, and that's just really about the questions that you ask yourself. So the retail banks, you know, it depends how much they're charging you as well. So that's something else that we talked about earlier. Check how much the charges are. It might make a lot of sense if it's, you know, a simplified investment offering that you've got there that's not costing you a lot of money. But again, it really is, it's such an individual thing. If you think you'd like to have a bit more of a hands-on approach with your investments and you'd like to pick your own investments, then maybe you want to explore some other platforms out there. But there are lots of managed options as well, which we can come on to. But a lot of platforms like II offer managed ISAs. So it's great because if you're a less confident or less experienced investor, you can go on there, you can answer a bunch of answer a questionnaire that basically asks about your life, your rainy day funds, your employment status, your risk appetite, and it will recommend portfolios that you can then choose from that are managed for you. And most of them are pretty low cost. So that's also something to consider. Have a look at some managed ISAs if you are indeed investing in an ISA right now and you're not sure it's the right one for you. But I think a lot of people, you know, probably are familiar with their retail bank maybe, and then if it makes sense to stay with them, then I think there's a lot of people behaviorally kind of do that. There's no wrong or right. It just go back to maybe those fundamental questions and ask yourself whether it fits for where you are. That's what I would do. And if you're not sure, then ask for advice.
Yes, absolutely. Apply the safe method and see if that works. One quick one, because I'm really keen for us to get into more of the slides, but there's a very interesting question. Not investing yet. If you have debt, does this include a mortgage? That's a very interesting question.
That is such a good question.
Yeah.
This comes back to before you're investing, or say putting aside £25 a month, use that example earlier. Literally, it's wise to list out all of the outgoings you have each month, including a mortgage. And you know, if you've bought a property, that is a physical asset that it's almost like an investment. So I would think of it like that. I would frame it as, these are my outgoings. I've got X amount I'm paying on my mortgage. I've got all of these life costs. And because again, you don't want to make investing the thing that puts you in a financially vulnerable position. It should just be building on it. So be honest again with your outgoings each month, including mortgages and things and life costs. It's a good question. We didn't really come onto that. And then work out how much you have to set aside. And the good thing is, going back to compounding, you don't need huge amounts to set aside into an ISA for it to, if you're diversifying and you've got a well-balanced portfolio, to really grow your money over time. And yeah, so that's how I would think about it. But if you're really unsure, ask a financial advisor and they will help, or maybe check out the Money Helper website.
Okay. Cool. Let's try and go through a bit more. We have a lot of content. Give us a thumbs up if you want to have a second version of this, because there's a few minutes left in this and we still have a lot to unpack. So let us know if you'd want another one of these sessions. We'll have a poll anyway at the end and a few questions. But let's move on to how to actually invest, the different types of accounts. And then, you know, I'm really keen to talk about wrappers as well.
Yeah.
So let's sorry everyone, but we're going to try and speed it up. So
we'll
a lot more slides.
We'll dart through these. There's always so much to cover in these, because it's the landscape is vast. But yeah, so as I was saying earlier, these are the main accounts that you usually get on an investment platform: your ISAs, your SIPs, your GIAs, and your JISAs most of the time. And ISAs and SIPs, the main thing to really know about those is that they are tax efficient. So gains that you grow in those wrappers will be shielded from tax, and that is really, really important. Same with a JISA. They all have different allowances. So your JISA's £9,000 every tax year, and then the ISAs are £20,000 at the moment. So that's something to bear in mind as well. And obviously, if you can use the most of your allowance each tax year, that is fantastic as well, because that can only be really a good thing. So that's really, in terms of a snapshot, all you really need to understand. And then it's just choosing which one is right for you based on where you are. But if you can use a tax efficient account, a wrapper like an ISA or a SIP or a JISA, then that's usually a great start.
Wonderful. And then we've touched on wrappers. So let's talk briefly about the different types of asset wrappers.
So when you're actually investing, so once you've got your ISA or your SIP and you are picking your investments yourself, and as I said, you do not have to pick your investments yourself. There are managed portfolios out there that you can use. which will be based on your risk appetite and stage of life, which are fantastic if you're less confident, or some people just don't feel like they have the time or the inclination to pick their own investments. Absolutely fine. If, however, you are looking at building your own portfolio, it will feel overwhelming at the beginning. That is completely normal. There is a vast amount of choice out there. But the good news is you don't have to be some sort of expert stock picker to build a really brilliantly well-diversified portfolio. The key thing is to kind of get to grips with some of these different assets that we've laid out here. You don't need to be an expert on all of them. There's so many tools out there, including, you know, our website on II, which has guides which really explain all of these. But the one that isn't on there is equities. So if you're investing in stocks, you're buying shares in a listed company. A lot of people, you know, might buy individual companies as part of their portfolio, and that's usually when people talk about investing, that's usually what people are talking about. I've invested in Tesla or something like that. Tesla is actually a very popular one on our platform, and there are loads of different ones we'll come on to. But you can also invest in collectives, and so an example of a collective is a fund, and that's just a pooled investment. They are usually managed either by a fund manager, or they are passively managed, so they track an index. And it's as it sounds, a collective is just a collection of investments. The good news is that's a great way to spread your risk or to diversify, because you've got a collection of investments, and you're not just picking individual companies which may or may not perform well or worse at different times. Investment trusts are similar. They're just a different structure. And there's a lot that you could kind of talk about. You don't really have to get into all of it right now. But if you are interested in something called investment trusts, which are pooled investments but listed on the stock exchange, you can go on to the Association of Investment Companies, which is the trade body equivalent for that sector. And they've got loads of great stuff on there. ETFs are becoming more and more popular. Most people have probably heard of them, especially younger investors. They are a type of fund. They're passively managed, so that means they track an index. But they usually have exposure to kind of a range of asset classes, and it's just another way of accessing different investments. There's no best or worst for all of these. They all have different, you know, cons and advantages. The best approach is to really understand what the actual fund, trust, or ETF is invested in, so the underlying investments. And there are loads of different ways to do that and use different tools to find that. But if you're spreading them and having a range of different ones, then you've got, you know, you're spreading your risk. But there are so many different ways that you can invest, which is fantastic, but it can be overwhelming. So if you're not sure, then start small, build your confidence, and use those tools available out there to navigate these options, because there are loads.
Thank you. And then, guys, I thought it would be an abomination to have Camilla on and not try and dive into what they're doing at II. So I'm very interested in this slide, how the DIY investors are building their diverse portfolios at Interactive Investor. Could you give us a whistle stop of what they're doing, just maybe to give us a flavor of where we could start thinking about our own journeys?
Sure. Yeah. So this builds on what I was just saying. So interactive investor customers across loads of different age groups. And again, the charts sometimes look a bit overwhelming, but if you have a look at the bottom there, it's got a breakdown of equities, so companies, funds, which we just talked about, and investment trusts, all the different colors. And you can see the bars look quite even, which shows that basically interactive investor customers in their ISAs, in their GIAs, in their SIPs are holding a range of these types of investments across a range of different sectors. So they are staying diversified, and they are staying invested for the long term. And it's paid off because the average customer has outperformed, and the portfolios have grown over the last 5 years by around 25.1%, which is pretty impressive. So as you can see there, it's basically got a collection of everything we've just talked about. Not all funds are actively managed, as we've just said. And that kind of gives you a bit of a snapshot. There are some names, I think, on the next slide, which you may or may not recognize. But this looks, again, quite overwhelming. But this just breaks down different age groups and what they're actually investing in the most, or what they're holding. You'll see some familiar names in there: Shell, BP, GSK, Tesla. Those are individual companies that people are holding. But you'll also see other names like Vanguard Life Strategy, which is an example of a passive fund. So as you see through all the columns, and like, you know, maybe go away and have a look at it, because again, it's a lot on first glance. But again, same message, a mix. You've got a mix of direct equities, you've got a mix of some funds in there, some ETFs. So all age groups across II, all experience levels, are building very well balanced portfolios. And that means they are spreading their investments in their ISAs, in their GIAs, in their SIPs across different regions, different asset classes, and different areas of the market.
Great. Yeah, I think that's important because I'm always nosy. I want to know what
Yeah,
it's doing.
yeah.
Quickly go on to you know, just to simplify things for everyone, because I'm conscious of time. It's lunchtime and that. But
Yeah.
if you would like another of these sessions more, you know, in depth, please join the Moneymatic community and let us know what else you'd like to hear about. But maybe this briefly, Camilla, just to help people have an anchor point.
Yeah. So building a portfolio yourself in your ISA, in your tax efficient wrapper, hopefully, when you are in a position to invest, once you've cleared debts, once you understand your stage of life and your risk tolerance and your financial goals, it can be really overwhelming at the beginning. So start small. It's more about staying the course than being some sort of expert stock picker. You absolutely don't have to do that. And I'd hate for people to be put off by thinking that they have to start, you know, timing the market. It's never about timing the market. It's just time in the market and being diversified. Don't put all of your eggs in one basket is essentially how you can sum it up. And if you're not sure, then ask, you know, and there are loads of tools out there. These are some of them. So on Interactive Investor, for example, we've got these. Other platforms will have other kind of iterations of these, but we have, for example, quick start funds. So if you are starting out with investing, but you're not sure where to start, you know, you need a balance of different types of investments and different asset classes and everything else. But you don't know where to start, that's got a great breakdown of options for you. And it kind of takes that kind of hard work out for you. Similarly, if you're starting to build your confidence, but you know what you want to invest in, say UK equities, US equities, but you're not sure which fund or which investment trust, you can go on to a rated list. Lots of different platforms have them. We have ours called Super 60, which is the best performing across different investments. And then we have ACE 40, which is actually our sustainable investment list. So if investing ethically and sustainably is important to you as well, then you can navigate that list as well. So that's a good tool if you kind of know where you want to invest, but you don't know exactly which fund or which ETF or which investment trust. And as I said, we've got managed products. Loads of platforms have managed ISAs. They're a really good tool to use if you are really overwhelmed and don't know where to start. And then from there, you can build, because ultimately the takeaway here is you can start small. You don't have to start doing everything all at once. You don't have to have it all figured out right now. It's more understanding what you want to get from this, putting yourself in the best position to start, and then building on it as you get more confident.
Yes, thank you so much.
No.
I'll take one question. We've run out of time. There's a very good question actually that can be quite confusing. Is it possible to open more than one ISA account in the tax year?
That's a really good question, and we've just written something on it, so I'm going to, it's because I won't do it justice speaking about it right now. I'll share it and you can read about it, because there's a few things to look out for, but I won't do it justice if I start talking about it now. That's a really good question.
Okay, so what we'll do is we have a community. I hope you can see the screen with the QR code. It's hopefully been put up, and if we could put back the poll on the forum as well. So if any of your questions haven't been answered, we will respond to them in the community forum. So you can go and pick up a question there. There'll be a feedback form that follows this. So let us know if you want to have another of these sessions. If there is anything in particular that you wanted us to touch on that didn't come across, please let us know. We are so thankful for you all. We've had quite a lot of interest in these. We've had over the past 2 sessions, just over 300 signups, so people are really interested in the topic. We had a few technical glitches the last time, so I'm really relieved to share that we fixed everything. Please, could you all join me in clapping for my team? Rodney, Murray, Paul, everybody that's working behind the scenes. Godwin, thank you all so much for putting this together, for fixing the tech issues from the last time. Thank you so much, everyone that came back, because the last one was technically not great, but we had a lot of returning people. And most importantly, Camila, thank you so much for your time. It's been awesome. I know for a fact we're going to do so many more of this together. We have such a good vibe together, and I'm looking forward to us doing more. Thank you so much, everyone, for joining. I'll put on that the next event we have is going to be choosing and using a financial planner. We don't usually think that we should have access to a financial planner, and yet we should. It's something that we have access to, and we should be trying to look into. Part of my coaching style is ask as many questions as you need to. It must be the lawyer in me. Ask, ask, ask. So the next event is on the 8th of May, 1 o'clock. How to choose and use a financial planner, or even consider the questions that you need to be thinking about, because financial planning should not be looked at from a point of view of going to someone. It's yourself as well, financial planning for yourself as a person. So hopefully see you at that one. And finally, if you'd like to grab a copy of the Thriving Beyond Borders book that I told you about, it's on Amazon, QR code for it. We look forward to seeing you at the next one. And Camila, it's been fantastic. Thank you so much, everyone, for joining. Please help us to fill out the feedback form and tell us, how we've done, what else you'd like to hear from us. We really appreciate you, and thank you for your time. Have a good day.
Thanks so much. Thanks, everyone.
Thank you.